Welcome students, I am Dr. Vijaya. In this topic, we are going to see unit number 16, mutual funds, venture capital and housing finance. This is from block 4, fund based services. Introduction. Before entering into the topic, we will have a general discussion about this mutual funds. Mutual funds are financial intermediaries which mobilize savings from the people and invest them in a mix of corporate and government securities. The mutual fund operates actively, manage this portfolio of securities and earn income through dividend, interest and capital gains. The incomes are eventually passed on to the mutual fund shareholders. Mutual funds represent one of the most important institutional forces in the market. They are institutional investors. They play a major role in today's financial market. The first mutual fund was established in Boston in 1924. Next, we will move on to the meaning and definition of mutual funds. Mutual funds are corporations that accept money from savers and then use these funds to buy stocks, long-term funds or short-term debt instruments issued by firms or governments. These are financial intermediaries that collect the savings of investors and invest them in a large and well diversified portfolio of securities such as money market instruments, corporate and government bonds and equity shares of joint stock companies. They invest the funds collected from investors in a wide variety of securities, that is through diversification. In this way, it reduces the risk to an extent. Mutual fund is a trust that pools the savings of investors. The money collected is invested in the financial market instruments such as shares, debentures and other securities. The income earned through these investments and the capital appreciation realized are shared by its unit holders in proportion to the number of units owned by them. Thus, mutual fund invests in a variety of securities which is called diversification. This reduces risk. Diversification reduces the risk because all stock and or debt instruments may not move in the same direction. Mutual funds are investment options through which an investor can put their money in equity, debt or hybrid instruments. There are different funds which are created by asset management companies of various risks. Each fund is managed by a fund manager. According to the Mutual Fund Fact Book published by the Investment Company Institute of USA, defines that a mutual fund is a financial service organization that receives money from shareholders, invests it, earns return on it, attempts to make it grow and agrees to pay the shareholder cash demand for the current value of his investment. In short, a mutual fund collects the savings from small investors, invest them in government and other corporate securities and earn income through interest and dividends besides capital gains. Next, we will move on to the features of mutual funds. Mutual fund possesses the following features. Mutual fund mobilizes funds from small as well as large investors by selling units. Mutual fund provides an ideal opportunity to small investors, an ideal avenue for investment. Mutual fund enables the investors to enjoy the benefit of professional and expert management of their funds. Mutual fund invests the savings collected in a wide portfolio of securities in order to maximize return and minimize risk for the benefit of investors. Mutual fund provides switching facilities to investors who can switch from one scheme to another. various schemes offered by mutual funds provide tax benefits to the investors. In India, mutual funds are regulated by agencies like SEBI. The cost of purchase and sale of mutual funds is very low. Mutual funds contribute to the economic development of a country. Now we will see what are the main goal of mutual funds in India. First objective is to mobilize the savings of the people. Next, to offer a convenient way for the small investors to enter the capital and the money market. To tap domestic savings and channelize them for profitable investment. To enable the investors to share the prosperity of the capital market. To act as agents for growth and stability of the capital market. To attract investments from the risk averters. To facilitate the orderly development of the capital market. Next, we will see what are the advantages we are having in mutual funds. Mutual funds are growing all over the world. They are growing because of their importance to investors and their contributions in the economy of a country. The following are the advantages of mutual funds. Mobilize small savings. Mutual funds mobilize small savings from the investors by offering various schemes. These schemes meet the varied requirements of the people. The savings of the people are channelized for the development of the economy. In the absence of mutual funds, these savings would remain idle. Next advantage is diversified investment. Small investors cannot afford to purchase the shares of the highly established companies because of high market price. The mutual funds provide this opportunity to small investors. Even a very small investor can afford to invest in the mutual funds. The investors can enjoy the wide portfolio of the investment held by the fund. It diversified its risk by investing in a variety of securities like equity shares, bonds, debentures, etc. Next, provide better returns. Mutual funds can pool funds from a large number of investors. Because of huge funds, the mutual funds are in a position to buy securities at cheaper rates and sell securities at higher price. In short, mutual funds are able to give good and regular returns to their investors. Next, better liquidity. At any time, the units can be sold and converted into cash. Whenever investors require cash, they can avail loan facility from the sponsoring banks against the unit certificates. Low transaction cost. The cost of purchase and sale of mutual fund units is relatively less. The brokerage fee or trading commission etc. are very lower. This is due to the large volume of money being handled by the mutual funds in the capital market. Next, it reduces risk. There is only a minimum risk attached to the principal amount and return for the investments made in mutual funds. This is due to expert supervision, diversification and liquidity of units. Professional management. Mutual funds are managed by professionals. They are well trained and they have very adequate experience in the field of investment. Thus, investors get quality services from the mutual funds. Offer tax benefits. Mutual funds offer tax benefits to investors. For example, under Section 80L of Income Tax Act, a sum of rupees 10,000 received as dividend from a mutual fund, or in a case of UTI, it is rupees 13,000, which is totally deductible from the gross total income. Next point, it support capital market. The savings of the people are directed towards investments in capital markets through mutual funds. They also provide a valuable liquidity to the capital market. In this way, the mutual funds make the capital market active and stable. Promote industrial development. The economic development of any nation depends upon its industrial advancement and agricultural development. Industrial units raise funds from capital markets through the issue of shares and debentures. Mutual funds supply large funds to capital markets. Besides, they create demand for capital market instruments like shares, debentures, etc. Thus, mutual funds provide finance to industries and thereby contributing towards the economic development of a country. Keep the money market active. An individual investor cannot have any access to money market instruments. Mutual funds invest money on the money market instruments. In this way, they keep the money market active. Next, we will see mutual fund risk. What are the risks we found in mutual fund? In spite of the advantage offered by mutual funds, there are some risks also. This is so because mutual funds invest their funds in the stock market on shares. These shares are subject to risk. Hence, the following risks are inherent in the dealings of mutual funds. Number 1, market risk. These risks are unavoidable. Any investor cannot avoid this risk. These arise due to fluctuations in the share prices. Number 2, investment risk. Generally, mutual funds make investments on the advice sought from asset management company. If the advice goes wrong, the fund has to suffer a loss. Number 3, business risk. Mutual funds invest mostly in equity shares of companies. If the business of the companies suffers any setback, they cannot declare dividend. Ultimately, such companies may be wound up. As a result, mutual funds will suffer. Next, political risk. Change in government policies brings uncertainty in the economy. Every player, including mutual funds, has to face this risk and uncertainty. Next, we move on to the scheme risk. There are certain risks in the schemes themselves. Risks are greater in certain schemes, for example, growth schemes. Next, we will move on and we will see the present condition of mutual funds investments in India. In India, the first mutual fund was UTI. It was set up in 1964 under an Act of Parliament. During the year 1987 to 1992, 7 new mutual funds were established in the public sector. In 1993, the government changed its policy to allow the entry of private, corporate and foreign institutional investors into the mutual fund segment. Now, the commercial banks like the SBI, Canara Bank, Indian Bank, Bank of India, Punjab National Bank, etc. have entered into the field. LIC and GIC have also entered into the market. By the end of March 2000, there was 36 mutual funds and 9 in the public sector and 27 in the private sector. However, UTI dominated the mutual fund sector. In India, mutual funds are being regulated by agencies like SEBI. Mutual funds plays an important role in promoting saving and investment in the country. There are around 196 mutual fund schemes and the amount of assets under this management was rupees 47,000 crores in 1993 and rupees 80,590 crores in 2003, and it went up to rupees 2,17,707 crores by 31/3/2006. Thus, mutual funds are growing in India. However, their growth rate is very slow. Next, we are going to a new topic called venture capital. Now, we will see about the introduction of the venture capital. There are some businesses that involve higher risk. In the case of newly started business, the risk is more. The new businesses may be promoted by qualified entrepreneurs. They lack necessary experience and funds to give shape to their ideas. Such high risk, high return ventures are unable to raise funds from regular channels like banks and capital markets. Generally, people would not like to invest in new high risk companies. Some people invest money in such new high risk companies. Even though the risk is high, there is a potential of getting our turn often times more in less than 5 years. The investors making such investments are called venture capitalists. The money invested in new high risk and high return firms is called venture capital. Venture capitalists not only provide money but also help the entrepreneur with guidance in formalizing his ideas into a viable business venture. They get good return on their investment. The percentage of the profits the venture capitalists get is called the carry. Next, we will move on to the venture capital's meaning and definition. The term venture capital comprises of two words, namely venture and capital. The term venture literally means a course or proceeding, the outcome of which is uncertain, that is, involving risk. The term capital refers to the resources to start the enterprises. Thus, venture capital refers to capital investments in a new and risky business enterprise. Money is invested in such enterprises because they have high growth potential. Venture capital is the money and resources made available to startup firms and small business with exceptional growth potential, that is IT, examples IT, infrastructure, real estate, etc. It is fundamentally a long-term risk capital in the form of equity finance for the small new ventures which involve risk. But at the same time, it is a strong potential for the growth. It thrives on the concept of high risk, high return. It means a means of equity financing for rapidly growing private companies. Venture capital can be visualized as your ideas and our money concept of developing business. It is patient capital that seeks a return through long-term capital gain rather than immediate and regular interest payment as in the case of debt financing. In short, venture capital means the financial investment in a highly risk project with the objective of earning a high rate of income. Next, we move on to the features of venture capital agencies. The important characteristics of venture capital finance are outlined as below. It is basically equity finance. It is a long-term investment in growth-oriented small or medium firms. Investment is made only in high-risk projects with the objective of earning a high rate of return. In addition to providing capital, the venture capitaler takes an active interest in the management of the assisted firm. It is rightly said that venture capital combines the qualities of banker, stock market investor and entrepreneur in one. The venture capital funds have a continuous involvement in business after making the investment. Once the venture has reached the full potential, the venture capitalist sells his holdings at a high premium. Thus, his main objective of investment is not to earn profit but capital gain. Next, we move on to the types of venture investors. Generally, there are three types of venture capital funds. They are as follows. Venture capital funds set up by angel investors, angels. They are individuals who invest their potential capital in startup companies. They are about 50 years old. They have high income and wealth. They are well educated. They have succeeded as entrepreneurs. They are interested in the startup processes. Next, venture capital subsidiaries of corporations. These are established by major corporations, commercial banks, holding companies, and other financial institutions. Number 3, private capital firms funds. The primary source of venture capital is a venture capital firm. It takes high risk by investing in an early stage company with high growth potential. Next, we move on to the stages of venture capital. Stage 1, seed capital. The descriptor seed is appropriate here since it suggested money that will fuel a startup's growth down the road. Seed funding rounds are typically small and are channeled toward research and development of an initial product. The money may also be used for conducting market research or expanding the term. Stage 2, startup capital. This stage is similar to the seed stage with initial market analysis conducted and business plans in place. Companies look to begin marketing and advertising the product and acquiring customers. Organizations at this stage likely have at least a sample product available. Venture capital funding may be diverted to acquiring more management personnel, fine-tuning the product, service, or conducting additional research. Next, we move on to the stage 3rd, early stage, first stage or second stage capital. Though sometimes called first stage, this stage only comes after the seed and startup ones in most cases. Funding received at this stage will often go toward manufacturing and production facilities, sales, and more marketing. The amount invested here may be significantly higher than during prior stages. At this point, the company may also be moving toward profitability as it pushes its products and advertisements to a wider audience. Stage 4, expansion stage, second stage, third stage capital. Growth is often exponential by this stage. Accordingly, venture capital funding serves as more fuel to the fire, enabling expansion to additional markets, for examples, other cities or countries, and diversification and differentiation of product lines. With a commercially available product, a startup at this stage should be taking in ample revenue, if not profit. Many companies that get expansion funding have been in business for 2 or 3 years. Next, we move on to the advantages of venture capital. Venture capital has a number of advantages over other forms of finance. Some of them are: it is a long-term equity finance, hence it provides a solid capital base for future growth. The venture capitalist is a business partner. He shares the risk and the returns. The venture capitalist is able to provide strategic, operational, and financial advice to the company. The venture capitalist has a network of contacts that can add value to the company so that he can help the company in recruiting key personnel, providing contracts in international markets, etc. Venture capital fund helps in the industrialization of the country. It helps in the technological development in the country. It generates employment. It helps in developing entrepreneurial skills. It promotes entrepreneurship and entrepreneur in the country. Next, we will see what is the current scenario of venture capital in India. Venture capital in India was known since 90s era. It is now that it has successfully emerged for all the business firms that take up risky projects and have high growth prospects as well. Venture capital in India is provided as risk capital in the forms of shares, seed capital, and other similar means. In 1988, ICICI emerged as a venture capital provider with Union trust of India. And now there are number of venture capital institutions in India. Financial banks like ICICI have stepped into this and have their own venture capital subsidiaries. Apart from Indian investors, international companies too have settled in India as a financial institute providing investments to large business firms. It is because of foreign investors that financial markets have developed in India on a large scale. Introduction of Western financial philosophies, tight contracts, focus on profitable projects and active involvement in finance was contributed by foreign investors only. The financial investment process has evolved a lot with time in India. Earlier, there were only commercial banks and some financial institutes, but now, with venture capital investment institutes, India has grown a lot. Business firms now focus on expansion because they can get financial support with venture capital. The scale and the equality of the business enterprises have increased in India now. With international competition, there have been a number of growth oriented business firms that have invested in venture capital. All the business firms that deal in information technology, manufacturing products as well as providing contemporary services can opt for venture capital investment in India. Now we will see a new topic called housing finance. India's national housing policies insist on providing more dwelling houses to the citizen. It is only natural for the government to create institutions which can provide housing finance. At the international level, institutions such as World Bank and Asian Development Bank provide both grants and loans, especially soft loans for removing slums and for the creation of housing colonies. In fact, in India, the World Bank has financed the sites and service schemes to a number of state governments, thereby both housing and promotion of small scale industries are simultaneously encouraged. Now we will see the exact meaning of housing finance. Housing finance shall mean financing for purchase, construction, reconstruction, renovation, repairs of residential dwelling units, which includes loans to individuals or group of individuals, including cooperative societies for construction, purchase of new dwelling units. Now we will see what are the main advantages of housing finance that the people can use. Among the financial service, housing finance creates employment both directly and indirectly. Industries such as cement, brick manufacturing, sanitary products, electrical fitting, sand glass industries experience more demand due to house construction. Rural housing develops not only rural areas but prevents migration of labor to urban areas. Housing finance helps in creation of more houses, which results in building up more infrastructure facilities such as roads, electricity generation, drinking water facilities, etc. Factories or industrial development create own townships by providing more housing facilities to their employees. Housing finance thereby reduces congestion in urban areas. Due to housing finance, there is a vertical expansion and rebuilding of depleted houses, and remodeling of the existing houses. Housing facilities not only improve, they also reflect the culture of the country. Chandigarh city is an example for modern housing which has been built by a French architect. Non-conventional energy gets popularized due to modern housing facilities, which are one of the major benefits of housing finance. Next, we move on to the characteristics of housing finance. Several characteristics the housing loans apart from credit for investment is called small scale business. These are mainly, first point, for the majority of poor and middle income applicants invest in housing does not yield a direct income, so economic returns on capital for dwelling units cannot easily be calculated. The amount of loan required to finance a dwelling unit is large in relation to the monthly income of applicants. This amount is related to the construction cost, which, even for a small unit of minimum standard, is usually about 40 to 50 times the monthly income of the borrower. Related to the size of the loan and its long term repayment, which usually takes at least 10 years, but it's frequently for 15, 20, or even for 25 years. The common procedure is to use the house and the title to the land to secure the loan against the risk of non-repayment. This requires a legal tenure document to be surrendered to the lending institution. Annual or monthly payments for the interest and amortization are conventionally fixed over the lifetime of the loan. Although variable interest rates and gradually increasing installments are very becoming popular. The first type matches the long-term yield of the mortgage loan to the changing cost of funds to the finance institution, while the second type allows for low initial installments followed by an accelerated repayment over the period of the loan. Loans cover only a percentage, usually 60 to 80% of the cost of the investment or the purchase price of a dwelling unit. The rest has to be financed out of private savings or through self-help labor. Next, we will see what are the tax benefits of housing finance or a home loan. In order to encourage more house construction in India and to boost housing finance, the Income Tax Act provides concession to the assessors, under which rupees 30,000 can be availed as tax relief if housing loan was availed for house renovation work, and if loan was availed for construction purpose, the interest payment up to rupees 2 lakhs per year can be written off from the gross income, and the principal paid is covered under section 80C while computing the income tax. Though the Kelkar committee has recommended to the government to withdraw these concessions, it is doubtful as to how far government may agree to these recommendations. So these are the major housing finance institutions. A number of institutions play a dominant role in the field of housing finance. The most important ones are the following: National Housing Bank, commercial banks, cooperative banks, Housing and Urban Development Corporation Limited, Housing Development Finance Corporation, and other private finance companies and insurance companies. What are the general problems of housing finance sector faces in India? Housing finance is relatively a new idea in the finance sector of India. It is developed rapidly during the last 2 decades due to the enthusiastic interest of the government of India to cut short the housing problem of the country. Some of the general problems of housing finance sector as is under: Number 1, government policies for housing finance sector. In the present circumstances, the government of India is trying to play the role of facilitator by offering a number of housing schemes for different sections of the society. But due to poor administrative control and lack of strong willpower, most of the schemes are squeezed only up to the primary levels and are never attained its ultimate objectives. Problem number 2, role of housing finance regulatory authority. The word regulation refers to the specific constraints in the natural growth of a sector, and the regulatory body is considered as a group of people who always include in search of the ways which could create checks and balances to hinder the unplanned and improper growth of the related area. Development of fundamental infrastructure for housing and technology innovations. Housing is primarily an urban phenomenon. It needs some basic infrastructural facilities like roads, development, electricity and water supply, proper drainage system, etc. to grow. Most of these facilities depend upon the government efforts and interest. However, the technical inventions in the part of housing construction also support and promote the housing market in the country through the cut down the cost of construction up to a reasonable level. Both of these efforts affect the housing finance market of the country directly. It is a noble symbol that the central and the state governments of India are concerned enough about housing schemes frequently. But due to the unstable political environment, like the other areas, most of the housing schemes are limited up to the paperwork or within the primary stage. The elementary infrastructural amenities for housing development area not available in most of the areas of the country. Thus, the constant efforts are done from the side of Indian government, but these are not enough to give a boost to the housing industries. The higher income group of society is depending on the private company for infrastructure development of residential areas by paying more amounts. What about the middle or lower income group? They are obligatory to live in non-authorized and non-developed zones where housing finances facilities are generally not provided by the housing finance companies. Next, distribution of national income among population. The distribution of national capital among the population of the country affects the housing finance sector directly. If the capital of the nation is distributed among the population in a rational manner, the most of the population of the country will be in a position to dream for their own houses, and the chances of growth of housing finance sector of the country will remain higher. Next point, non-availability of funds. Financing in any area depends on the availability of funds for the purpose. Housing finance is a long-term investment which requires plenty of funds. One of the main problems of the housing finance sector of India is non-availability of long-term capital for investment. Conventionally, the funds for the housing sector have originated from the individuals themselves by way of their own savings or from the financial institutions that are primarily engaged in the intermediation process of channelizing funds from the savers to the borrowers. But the funds so organized through the formal sector financial institutions remain much lower than what is required to tackle the problems of housing finance in India. Higher cost of acquisition of land. It needs not to be mentioned that in the present time, the supply of I and is perfectly inelastic for a company. The availability of I and inadequate quantity at the right place and at right affordable price by the individual is more important for the housing finance sector. The inelastic supply of suitable income and results in a superior increase in the cost of real estate. Besides, the very high stamp duty payable at the time of purchase of property also causes an increase in the cost of income and significantly. It gets priced out many potential housing finance customers in owning a house. The last one, static culture of the society. Among Indian society, the housing is a lifetime dream of an individual, and a newly employed person cannot even imagine for his own house due to his social and cultural backgrounds. Although his attitude of society is changing from the last decade due to the development of nuclear families, tax rebate on housing loans are different. Secondly, the debt is considered as an evil in Indian society, and the concept of deficit financing is not appreciated by the masses. This type of thinking discourages a person to avail the facility of housing finance and ultimately hurts the housing finance market of the country remarkably. Although this concept is now changing. which is evident from the fact that average age of borrower is around 40 years. The joint family culture of the Indian society also legs the housing finance market to some extent. Thank you. We will end our session by this.